Hello, everybody. I am Daniel. I'm the founder of Startup CPG. If you're watching us on YouTube, make sure you hit subscribe. You'll get a lot of recordings like this. This is the third part of a three-part series that we have done with the Finaloop team, all about Finance 101 for CPG brands. And the first two have been incredibly well received. I have gone through this deck as well, and I know that this one will be also. So thank you so much to the Finaloop team for bringing all of this incredibly useful information to all the founders in our community. I think we're going to be paying particular attention to this one. We don't then we have to when we finally get to the point of earning money. So thanks a lot. And I am going to, with that, pass it over to Rayla to kick us off.
Sure. Hello, everybody, and thanks so much for having me here. I'm excited to dive into the fun world of tax. And if we're all being completely honest, my guess is that most of you are not super excited to talk about tax. It's not exactly the sexiest topic in the world. But if you're here, that means that you get it, that you understand the importance of, the importance of understanding the basics of tax. And you won't become a tax expert by listening to this 1 hour a webinar. You're not going to become a tax expert. But what's really important is that you understand the questions that you need to ask your CPA, because you can't just rely that your CPA is going to claim all these deductions for you without asking for it. I think if you go to 3 separate CPAs and ask them each to prepare your tax return, you're going to see 3 separate tax returns. You'd be surprised at how much of that is really subjective based on what the CPA knows, what the CPA is comfortable with. If the CPA is somebody who works with other CPG brands, that's also a big factor. So understanding the questions to ask is a key factor. So with that, just a quick intro about me. My name is Rayla Rappaport. I am the head of product marketing at Finaloop. I'm also a CPA for more years than I want to admit. But before my life at Finaloop, in my previous life, I worked at PwC for over 12 years. And there I worked with large global companies and provided them consulting on tax strategy. And then last 4 years at Finaloop, I've been focusing exclusively on e-commerce, multi-channel, wholesale, and retail brands, so all different consumer brands. And one of the key differences I noticed between my clients before and my clients now is that, larger companies, they know what they don't know. So they'll be able to say, okay, I don't know this one. Let me go ask the right resources and bring in the resources to get help on that. Most smaller brands, the founders are flying blind when it comes to tax. It's not something that a lot of people know the basics of. And again, when you're relying on your CPA to do it without knowing the questions to ask, you are going to be missing a lot of potential tax deductions and potential tax benefits just because your CPA does not know your business like you do. So you need to be your own best advocate here and ask these questions. And that's really one of the reasons that we're so passionate about this concept of financial education. And we've had this series with Startup CPG. Just a very, very quick update about Finaloop. If you do not know who we are, we provide real-time bookkeeping and accounting services for consumer brands. So we connect to all of your tech stack, your Shopify and Amazon and your invoices and your banks and credit cards and Gusto, all of the different apps. And we bring in all of that data from the sources of truth into our accounting software and create real-time P&L balance sheet cash flow. We have a team of actual accountants who are reviewing your numbers and answering your questions, so that way you get the best of both worlds, both the automation and the expert support.
Rayla, when is the right time for people starting a brand to start thinking about using this kind of a beautiful automated system like Finaloop for their taxes?
That is an excellent question. So we actually work with brands of all sizes, from really starting companies to where have almost 9-figure brands, so very high 8-figure brands, and we actually do like a tiered pricing so that way even a smaller brands we can work within their budgets as well. It's never too early to start tracking your financials. Obviously, as you grow, the complexity of things and the types of specific services and the different features you'd be using in Finaloop might change. But in terms of being able to track your financials, that's something you should be doing from day one.
Cool. And just in case anyone wants to reach out to you, can you just go back to that previous slide that has the QR code on it, just so everyone has a chance to, if you guys want to reach out to the Finaloop team, they will talk to you. They'll tell you what's going on. They'll give you that tiered pricing, so you can feel free to scan that. And I think that goes to our custom link. So I'll try to put that in the chat also.
Perfect. And by the way, also, if you like to find me on LinkedIn, if you have any additional questions, there are not many Raylas out there, so I should be pretty easy to find. Rayla Rappaport is how I'm written in LinkedIn. So feel free to reach out with any additional questions after.
And I'll put that link in the chat now too. I think it's a custom one.
Okay, great.
Cool.
And now before I dive right in, I'll hand it over to Cleet for a quick intro as well.
Yeah, thanks for attending, everybody. Cleet Wertz, I've been in the sales tax space for 20 years. I did not grow up wanting to be in the sales tax space for 20 years. Like I want to be in the sales tax space, but here I am. I love it. It's probably why I have so much gray hair. But I'm COO of Zamp. I've worked at a number of sales tax software companies, and excited to be here. And I'll just, to your point, Rayla, is just you're not going to be an expert at the end of this, but hopefully you can take some nuggets as to just things you need to be aware of and thinking about as you start and grow and scale your business. And if you have any questions, please don't hesitate to reach out. So excited to talk about this.
Okay, great. So first, just to cover the agenda, and I'd like to just, I guess, disclaim here that, obviously a lot of the tax, the devil's in the details. So we're not going to dive into all of the different possible use cases. And what we are going to dive into is really practical application of the rules, but super high level rules. So that way the idea is just to give you that basis so you know what to ask. So we'll start off with a little bit about choosing the right business structure. Even if you are a company that has been around for a couple of years, this is still relevant for you. You should be reconsidering that every couple of years and making sure that the structure you have now is still relevant for your current business goals, since those can change. We're also then going to talk about some of the most overlooked deductions for CPG brands. These are different deductions that I see brands miss all the time, and it's just leaving money on the table. We're going to talk on the cash versus accrual side. I'm going to talk a little bit about a common misconception that I see even among CPAs who miss this, especially if you're not very familiar with the ins and outs of CPG brands. And I think it's important for all of you to be aware of that. And then, of course, in 2025, you can't have a discussion about tax without talking about tariffs. So we'll talk a little bit about the tariffs and Trump's current tax proposals and what that can mean for your business. And then I'll hand it over to Cleet to cover the sales tax side, which obviously for any online business, there's a lot of complexity there as well. All right, so let's dive in first to choosing the right business structure. And as I said before, if you've been in this for 2, 3, 5 years, you might think this is not relevant to me. I've already chosen a structure, I've already invested in it, and I'm comfortable with it. But that is actually a really, really big mistake, because as your business grows, your needs change, your goals change. It could be that you now plan on exiting in the next few years that you didn't originally, or up until now you've been a bootstrap company, but now you want to bring on investors. Especially for brands that start off not being profitable. It's very typical to start off as a very simple structure, but then as you become profitable, that's not necessarily the most tax efficient. So just to give you a quick overview, a legal structure and a tax structure are not necessarily the same things. And that actually works in our benefit, because it allows you to mix and match based on what you need. So you can decide from a legal perspective what type of legal structure you want, and then from a tax perspective what works as well. The legal structure I will not go into, since I'm not a lawyer. But on the tax side, I want to provide you a little bit understanding of the different types of tax entities and what that would actually mean for you in terms of the cash that you're taking home. So here I just added a summary chart that really covers, the different entities and then all the different tax structures that you can be when having that legal entity. So let's start off with a sole proprietorship. Now, a sole proprietorship is essentially the simplest form of business. You can even do it without having any legal entity, or you can create a LLC. And essentially it means that, you are one founder who has decided to start a CPG brand, and you have no idea if there's going to be product market fit. You have no idea if it's going to grow anywhere. So you're not going to start investing in a super complicated legal structure or tax structure. You want to just start something simple and see how it goes. In this case, a sole proprietorship is a great option in the beginning, especially as you're not a profitable business net, so you don't have to worry too much about the tax implications. But essentially, the way that it works is you have all of the cash, all the net income of the business flowing straight up to your personal tax return. There is no separation between you and your business for tax purposes. whether you have an LLC or whether you have no entity at all. I used the juggler here because I figured that was probably the best emoji depiction of a CPG brand founder, considering what you have to do every single day to get to manage your business, really. But what happens is when that net income flows up to your personal tax return, you now have to pay tax on it in your personal tax return on your Schedule C. And you'll be paying your personal tax rate, which is marginal up to 37% currently, although that might change depending on the tax proposals, plus an additional 15.3% of self-employment tax. It's a huge amount of tax to pay on this net income, which is why as you become more profitable, this might not be the right fit in the future for you. There's no payroll option here, so you wouldn't pay yourself a salary. Instead, you can just take an owner's draw directly from the company. If you want to take out money, you already pay tax on everything, so there's no additional tax for that. And there is one tax benefit that I'll mention called QBI, Qualified Business Income Deduction. That is actually set to expire this year, but it also might be extended based on the tax proposals. And what it means is, from your net business income, if it's qualified business income and you're below certain thresholds of income, then you can get a 20% deduction as well to lower your taxes. This is for any flow-through business. So everything basically except for a C corporation. Now we're going to move on to partnerships, and I'll say partnerships are very similar to a sole proprietorship in terms of the way that it's treated and the way that it's taxed. The key difference is that a sole proprietorship has one founder, one owner, and a partnership has more than one. So you can be 2, it can be 4, it can be 100. It doesn't really matter. And in this case, also all of the cash and the net income of the business would flow directly up to the personal tax returns of each of the different partners based on the percent of the profits that they get. And there also it would be taxed at up to 37% plus 15.3% self-employment. So again, it's a very high tax. Here also there's no salary. There is something called a guaranteed payment, which is similar to salaries in some ways, in that the business can get a tax deduction for it, but it's also taxed at the level of the partner, still at that 37 plus 15.3%. So I don't know if you noticed the theme so far, but essentially both the sole proprietorship and the partnership have this fairly high tax. So it's great for starting off when you're maybe not too profitable, but it might not be the best option for you to continue. Okay, now we're going to get into some of the more complex structures. So essentially, once you get to a point after a few years where you are profitable, that's really when you should start thinking about, is the structure that I have now still the best structure for me? And that's really when people start thinking about an S Corp or a C Corp. An S Corp is also a pass-through entity, just like a partnership, but it has a little bit of a twist. An S Corp can have one shareholder or multiple shareholders, so there's flexibility on that front. And the way that it works is you have all of the net income of the business that's also flowing up to the shareholders. But you separate that net income into, it's really 2 different types of categories of income. One is a salary that needs to be paid to the employees. So as a founder, if you're actually managing your business and you are providing services to that business, you would also be considered an employee of the corporation. And as an employee, you would need to pay yourself a reasonable salary. Reasonable salary is super subjective. Essentially, you can think about, if you would hire someone to replace you in order to do all of the activities that you're doing for that business, how much would you be willing to pay them? That's a good rule of thumb. But this is something that is very subjective and really depends on the facts and circumstances of your business. But it is something that the IRS really scrutinizes and really looks at. So you want to make sure to come up with something that's really reasonable. And on that portion of your whatever the reasonable salary is, the S corporation would be able to get a deduction for that salary. And you would have to pay payroll tax, which effectively is also that 15.3%. So on that part of the income, you would still pay your personal tax of 37% plus the 15.3%. But the real benefit comes from the fact that all of the other net income, all the rest of the net income of the business, after you take away that salary, would only be taxed at the 37%. You can save a significant amount of taxes that way by not having to apply that 15.3% self-employment tax on all of the other net income of the business. So I'm going to show you just a super quick example here, just so you can kind of see what the numbers can do. Now, this is obviously talking about a fairly profitable business, but it takes takes the same business and says, okay, if you're an S corp, what would happen versus if you were a sole proprietorship? In this case, this business has $800,000 of net income and came up with a reasonable salary of $170,000. And I won't take you through all the boring details of the numbers here, but the important part is that when it comes to these numbers specifically, there's potential savings here of almost $20,000 for being an S corporation. That's 1 year of savings. So imagine you take this throughout several years, you can have significant savings from not having to pay this additional tax. Having said that, of course, there are certain complexities with an S corp. So first of all, there are specific requirements that you have to meet in order to be an S corporation. One is that you can only have one class of stock. There is a shareholder limit of 100 shareholders. In my experience for CPG brands, that is rarely an issue. And also all of the shareholders, whether it's one or multiple, have to be U.S. resident individual shareholders, hence the American flags. The thing about an S corporation is it is a bit more difficult to bring in investors. A lot of investors don't want to speak to you until you're a C corporation, and we'll talk about that one in a minute. And also on the admin side, there is a key risk here, and the risk really is that that you may have inadvertently done something through the years that would jeopardize your S corporation status. So when I used to do tax due diligences in PwC and I was an S corporation, the first thing that I would look at is, did this company do anything that destroyed that S corp status? So even something as simple as having a loan between the shareholder and the business that's not properly treated as a loan, so there's no interest expense or things like that, it could be classified as a second class of stock, and then right away your S corp status is destroyed. So I'm not going to go into all the specifics here because I think that this is really the key is that this is something you should be speaking to your CPA about. Once you get to a point of profitability, if you're not planning on exiting in the next few years and you're not planning on bringing on investors, you really should consider the S corp. It can be a huge tax benefit for you. So it's something to start discussing with your CPA. And the last option here is the C corporation. The C corporation has a double layer of tax, so it's a little bit different than all of the flow-through entities that we've discussed up until now. The C corporation has a 21% tax rate, so the net income of that corporation would be taxed at 21%. That also might be changing potentially. Trump's administration is discussing it, but we'll see what happens there. But then when there are dividends paid from the corporation to the shareholders, they would be subject to another layer of tax. Typically, it's 15 to 20% of additional tax after that. But the key benefit of a C corporation, which is why it's something that investors really like to see, and it's why it's something that can be a very efficient structure if you plan on exiting, is something called the Qualified Small Business Stock Exclusion, the QSBS. Now, this can be a really, really game-changing tax benefit for you if you qualify. What the benefit does, what QSBS does, is if your business has QSBS, and then when you sell it, you can pay 0 federal capital gains tax on the capital gains related to that, up to the greater of 10 million or 10 times the adjusted basis that you put into the business. And that's per shareholder. So if there are multiple shareholders, think about a $10 million tax benefit and tax exemption for each of the different shareholders. That's huge. And that's 0 federal capital gains tax. It makes a really big difference. Some states also have something similar to this. But again, I'm not getting too much into the state side because that really depends on the state level. But in order to qualify for this, you need to be a USC corporation with less than $50 million of assets, both before and after it issued stock. 80% of the assets need to be used in an active trader business. Again, for a CPG brand, that shouldn't be a problem at all. It also needs to be the original stock issuance. So, if you received stock from the corporation and then sell it to a friend, that friend will not be able to benefit from this. It needs to be directly from the corporation. And also the investor must be an individual, not a corporation. If you qualify for this and you hold that stock for 5 years before selling it, then you can get this tremendous, tremendous benefit. Even if you sell it within the 5-year period, if you then use those proceeds to invest in another qualified small business, you can actually roll over that gain or defer that gain as well and tack on to additional years to that 5-year period. So again, it can be a really, really significant tax benefit. If you're planning on exiting or you want to bring on investors, talk to your CPA about the C corporation. All right. Next, we're going to talk about the missed deductions for CPG. And again, the point here is really just to give you this high-level overview of questions that you should be asking your CPA and not expecting your CPA to necessarily raise to you. So we're going to start with something called the accountable plan. And the accountable plan, it can be a real benefit, but also it's so simple to put into place that it would just be a shame to miss it. So to give you an idea of what this means, it's an IRS-approved policy for a business to reimburse its employees. And again, for an S Corp and a C Corp, an employee includes a founder. So it's a way to reimburse you or your employees for business expenses that in a non-taxable way. So let's just say, as an example, you bring a bunch of different boxes ready for shipment to the post office, and you want to ship it to all of your different customers, and then you realize that you forget your business card at home and you have to pay with your personal credit card. You can pay $3,000 worth of shipping expenses. If you have an accountable plan, those $3,000 would be fully deductible for your business as a business expense. And when the business then reimburses the $3,000 to you, you would be able to take that money completely tax-free. Without an accountable plan, the business would still get the $3,000 business deduction, but then when they pay you back that $3,000 reimbursement, you would have to actually withhold tax on that payment, and as an employee would have to pay income tax on that payment. So it significantly reduces the actual reimbursement that you're getting, which is why this is such an important plan to have in place. And it's also very simple to qualify. In order to meet the requirements of an accountable plan, one is you should have a written policy in place. This is not a must. You don't need to submit this to the IRS, but it's really best practice. So that way, if they do come back and ask you questions, you can show them your written policy. And in the policy, you should cover what the allowable business expenses would be that you're going to reimburse, and also the time restrictions in order to get the reimbursement. So for example, you should tell them that you have to, in order for an employee to get a reimbursement, you would have to track and document expenses in a reasonable time, which is typically within 60 days after the expense. If you have business advances, so for example, if you're going on a business trip and you want to pull out money in advance from the company, you shouldn't be doing that more than 30 days before the trip. And if there's any excess left over after that trip, you should return it back to the business within 120 days after. So as long as you're meeting these reasonable time points, then it should be respected as an accountable plan and you get that tax benefit. Okay, next we're talking about the home office and vehicle deductions. And here, I know that this is not going to be one that any of you will be like, oh, wow, I've never heard of that before. I think everyone's familiar with the concept of this. The reason that this is mentioned in my list of deductions that are often missed is one of the things that I see a lot is that CPAs just don't ask questions about it. So it could be that you'll be able to get this benefit, but if you don't raise it as a potential benefit for you, you might be missing it. And what the home office deduction is if you have an exclusive part of your home that you use for a business, a lot of CPG brands they have the home offices and are really based out of home headquarters. So if that's the case for you and you have a part of your business that you use exclusively as an office, so not if you're working at your dining room table, but you have a specific desk in an area and a room set up for your office, and if that's your principal place of business. If you meet those two requirements, you should be able to qualify for it. So for example, I typically am working in the Finaloop offices. Once a week, I work from home. Home is not my principal place of business. But if you meet both of these requirements, then you can get a deduction for, a bunch of your home-related expenses, mortgage interest, insurance, utilities, all of this list. Which is also important. And this can qualify whether or not you're an employee of a business, so an S Corp or a C Corp, but also if you're self-employed, like a sole proprietorship or a partnership. And there are two ways to be able to benefit from this. One is just a standard, easy way that's a specific, dollars per square foot, or there's a more complex where you can take a percentage of the total expenses. And it's the same thing with vehicle deductions. You can take a percentage of those expenses as a deduction, or you can take a fixed 67% per mile for a business mile if you're using your car for business expenses, for business travel. One thing I'll mention about the vehicle deductions is that if you're driving from your home to an office, that's not counted as business travel. But if you are, if your home is your headquarters and then you're driving to you're a warehouse or to one of the retail stores that you're working with, then those would be considered business travel in your car, and then you'd be able to get deductions for that. Okay, the next one relates to merchant cash advances or revenue-based loans. I don't know how many of you are familiar with this, so I'm going to just do a quick explanation of what an MCA is, which is, it's a little bit different than a typical loan. A typical loan, you get a principal amount of money, and then you have to pay a certain amount of interest. A merchant cash advance doesn't give you a fixed percent of interest, but instead you have to pay back a percentage of your sales over a period of time. And you have a certain finance, it comes out as a certain financing fee. From a legal perspective, an MCA is not considered to be a loan, and therefore the payments that you pay in order to get that amount of the loan, it's not considered to be interest expense. Now, quick story here, which is, I think, super relevant. And as I had a call with a brand, this was already probably 2 years ago. And at the time, they were 10 or 11 million dollars in revenue. So they're a fairly large brand. And I was looking at their financials before they started working with Finaloop. And one of the things I noticed is, he had a lot of Shopify Capital loans, which is obviously very common for e-commerce businesses. And I guess because he was working with an accountant that didn't really understand the nuances of e-commerce and of inventory-based businesses, they did not take any deductions for any of those financing fees related to this. And I think it came out to about $30,000 of an interest deduction or financing fee deduction that was missed there. So this is something that you really want to make sure to ask questions about if it applies to you, if you have any of these MCAs. And specifically, if you are an accrual basis taxpayer, and you have an MCA, depending on the terms of the loan, you have potential here to take a full deduction for those financing fees on day one of the loan, instead of spreading it out over a specific period of time. This is something that not many people know about, but if if you have a loan that spreads out from the end of this year to early next year, you can actually potentially get that full deduction in this year and save money on taxes. So again, this is something to ask questions to your CPA about. Okay, now we're going to talk about travel deductions. And, travel deductions also is one of those, it's one of those deductions where you guys are all familiar with. You've heard of it before. But I think that people don't realize that there are ways to optimize this. And that's really what I'm bringing up here. So you can start thinking about how that can apply to your business. In general, a travel deduction is if you leave your main place of work for at least one workday. So, if you're like a digital nomad, this doesn't apply to you. But if you have a main workday and you leave it for one day, then it does. It has to be ordinary and necessary travel expenses only. And you have to spend enough time on the business. What does enough time mean? It means for US travel, the majority of the time needs to be spent on business-related activities. And that also includes your travel days within the US. And for international travel, it means that at least 75% of your days need to be spent on business-related activities, unless the entire trip is less than 7 days. So, for example, if you're traveling for a 2-day conference in Europe, and then you spend 4 days there, for personal reasons, just to extend it a bit, you can actually get the full travel deduction for that trip. So, it's really, again, there's the ways to really optimize this so you're getting the full benefit. It has to be reasonable expenses only. So when you're renting a car, maybe stay away from the Lamborghini for now. But you can really deduct a lot of different types of expenses. So flights, rental cars, some lodging, about 50% of your meals, and essential services. Just to give you a very practical example, and again, I've actually seen this work, but it really depends on the details. So it's something just to think about. Is in the first example, you have a brand that travels on Wednesday, has a DTC conference on Thursday and Friday. And on Friday, they also fit in an investor meeting. And then they decide, that's the end of the business. But instead of traveling back right away, they decide to extend the trip. Saturday, Sunday, Monday are spent vacationing, and then Tuesday they fly back. In this case, the majority of the days are spent on business, which means the entire travel amount would be able to be deductible. But on all the other days, you would have to allocate the expenses related to business versus the expenses related to vacation, and only take those expenses for business. So the lodging on your pool days wouldn't be deductible. In the second example, you have a very similar setup, but instead they move the meeting with the investor to Monday. So you're staying there for the same amount of time. But the reason that you're extending your trip is not for leisure purposes, it's because for business purposes. And then of course Saturday and Sunday you're not working as you wait for your meeting, so you spend it by the pool. But in this case, you would be able to deduct the entire trip if you meet all of the details related to travel expenses. So again, something to think about if you are traveling. You want to think about the best way to optimize that. Okay, now let's talk about cash versus accrual. And this is something that I'm actually strangely passionate about because I hear this mistake so often. And every single time I hear a CPA make the mistake, I'm always just like, okay, this is something that must be clarified. But essentially, there's a common misconception when it comes to cash versus accrual. So first, just to kind of give you a quick refresher of the differences between cash and accrual. Cash is when the revenues and expenses are based on the movement of the cash, and accrual is based on when the revenues and expenses are based on the actual business transactions and when they're incurred. The biggest misconception that I hear, and I hear this from lots of brands and from CPAs, is that if you're a cash basis, you take everything in cash basis. And if you're an accrual basis, you take everything in accrual basis. And therefore, CPG brands or inventory-based brands should only be using accrual basis. Now, the way that it works from a tax perspective is that it doesn't matter if you're cash or accrual basis for every other aspect of your business. Either way, from an inventory perspective, you'll need to deduct and track your inventory and COGS expenses based on an accrual basis, meaning that you get to take those deductions on your P&L only when you're actually using your raw materials or selling your finished products, not when you're purchasing that. So whether or not you decide to be a cash basis taxpayer or an accrual basis taxpayer should be based on all of your other business considerations. For example, if you have a lot of sales that have terms of, a lot of retail sales that have terms of net 30 or net 60, so you're not collecting cash for a while, cash basis might be a better option for you, and you shouldn't decide it only based on inventory, even though accrual is also a really great option. So you have more of your sales matching your expenses and have everything more on a matching basis. But again, I think it's a more complicated and bigger picture than just cash versus accrual. And this is something a lot of CPAs miss as well. So be aware of it and ask your CPA the right questions. Okay, and lastly, let's talk about the tariffs and the tax proposals. So the tariffs, honestly, and I say what where tariffs are today, probably it has changed since I even started this webinar because there's so much volatility and constant back and forth. The main part to really understand is that right now there are 2 court cases in process related to the tariffs. Both of them are in appeal, so there's a lot of drama on that side, and things can change at any given point in time. But currently, you have a 10% baseline tariff that applies to all countries, with the exception of China. And China is currently at 30% rate that is effective for 90 days, which will expire in July. If negotiations between the US and China fail, it's going to revert to 54%, which is still significantly less than the 145% that it was a couple of months ago, but still very high. Now, the reason that this is super important, actually, first of all, let me just cover a little bit about what that actually means for your P&L. So what we did is we looked a little bit at the Finaloop data, and for 3 different industries, just to understand how these tariffs could actually potentially impact your brand. So let's look at the health and beauty industry as an example. In the health and beauty industry, the product COGS are typically about 18% of the net sales. Again, this is just based on an average. Not all of COGS are subject to these tariffs. So in this case, about 15% of the COGS actually would be subject to tariffs. So that means that a tariff impact of China of 30% would be about 5%, a little bit less than 5% on the total sales. That is actually really significant when we're talking about companies who have an average EBITDA of about 8%. Having a 5% hit on your P&L is actually really huge. So the reason that I'm telling you that this is so important is, at 145%, there is no hope for most businesses. Like most businesses can't survive 145% tariff. But now at 30% or even, potentially at 54% if it's done the right way, it really comes down to how you manage your business. So one thing that we see across the board is that while margins are shrinking a bit, people are getting much leaner. They're getting much better at reducing their OpEx in order to try to cover some of that, some of the margin tightening related to the tariff. So people are becoming smarter about how they're running their business. This is just a screenshot of the SKU analysis dashboard that we have in Finaloop. And the reason I'm putting it here is because it's just showing you an example of how you can really track your margins per SKU. And this is something that now you need this on a SKU by SKU basis, whether you're doing it in Finaloop or you're doing it, manually in Excel or using a different app. Having that type of visibility so you can start making decisions about how to protect those margins is really key to survive the tariffs. And lastly, I'll just give you a very quick update of the current status of the Trump tax proposals, the big beautiful tax bill as it's called. It's already been passed by the House by one vote, and now it's going to the Senate. So we'll see what happens there. But the personal tax rate is set to go up from 37. It's not really going up. It's reverting back to the original of the 39.6% because a lot of these tax changes that happened in 2017 are set to expire this year. So the proposed change would make the 37% permanent. The QBI, as I said, would be reinstated and also raised to potentially 23%. If you have any domestic R&D, so if you're doing new product development or anything like that in the US, you'd be able to deduct 100% this year rather than having to spread it over multiple years. And also for your 1099s, right now you have to file 1099s for any payments to freelancers or contractors that exceed $600 unless they fall in an exception. This threshold could potentially increase to $2,000, which also would significantly just reduce admin burdens for you. So that's also a potential real benefit for everybody. I think that's all I have. So unless there's some questions, I'm happy to pass it over to Cleet to take over on the sales tax side.
I think the main question people were asking was around if the LLC info, if there was a slide like there was for the others. I think it was on the sole proprietorship slide.
So an LLC is a legal, as I mentioned before, there's a difference between a legal structure and the difference between a legal structure and a tax structure. So the legal structure is the LLC, Limited Liability Corporation. But from an LLC, you can actually be any different structure for tax purposes. So if you have one owner for an LLC, then you would automatically be treated as a sole proprietor for tax purposes. If you have multiple owners, you'd automatically be treated as a partnership. And if you make an election to be treated as an S corporation, you would then be treated as an S corporation. And you can also do that for a C corporation. So I would say that the LLC is a really good place to, from a legal perspective, if you set up as an LLC, you then have a lot of flexibility on the tax perspective because you can really be any type of tax entity.
Okay, cool. Maybe Rayla, you could check the chat and just see if you can knock out some of the questions that have been coming in the chat and the Q&A while Cleet does his thing.
Okay, so I will kind of go through this. As I said, the purpose of my piece is just to make you aware of some of the, as Rayla has mentioned, there's a lot of moving parts to sales tax. And so one of the things that, whether you're starting it out or you're a 1 million, 5 million, $20 million dollar company, there's just some basics that you need to understand in regards to where do you need to charge sales tax. And there's two main triggers when it comes to sales tax. And the first one is, where am I physically located? And that includes not only employees and sometimes contractors, right? 1099 contractors, warehouses, drop shippers. So that's the easiest part, really, is where do I have a physical presence? And then there's the economic nexus, and that's based on how much revenue or how many orders you do in a state, and each business is required to track that. So depending on the business, there's different thresholds for each state, right? Of course, it's not going to be consistent. So each state has its own threshold. So some states, it's 100K and 200 orders. Some just have a revenue threshold. So you can see here, each state has different thresholds. And actually, over the last probably 6 to 8 months, there's states that have even changed or dropped some of the thresholds. So like Alaska, as an example, in January, they dropped the 200 transaction threshold. So Indiana dropped their threshold, their transaction threshold. So again, these thresholds also change depending on depending on the state legislature. So,
And Cleet, that's primarily direct to consumer type sales.
actually, it's all sales. So that will just tell you where you need to charge sales tax. So you could be selling digital goods. You could be selling downloadable software, SaaS services. So all of that, whether it's CPG or whether it's digital, these thresholds apply. Did I answer that question?
I think it's more just about like if you're doing retail shipments to these customers also. I think you're mainly talking about e-com type
Correct.
stuff. Okay,
That's
thank
right.
you.
Yep. Now, the other thing that sneaks up on you is the amount of exposure a business can have from a sales tax perspective. So even if you're only a $2 million revenue company, you could have exposure just based on economic nexus in 7 to 11 states. And a lot of businesses in the e-com CPG space really trigger that 200 order threshold. That's really the threshold that gets people. And so you can see here, as your business grows, it really shows the level of exposure your business has in these states. So, I mean, 4 million, you're in 14 to 18 states that you would need to track, calculate, and remit sales tax in. So it can grow pretty quick in regards to the number of states you have to track and start collecting and remitting in. Now, this is probably one of the biggest blind spots for businesses, because a lot of businesses will say, "Hey, Clea, I'm only selling wholesale, or I'm selling through a marketplace. I'm doing some wholesale and direct to consumer." And your wholesale and marketplace orders, they impact where you have to charge sales tax. Because as you can see, there are states that include wholesale orders and revenue against your threshold. Some just do wholesale, some are marketplace, and some account for both. So you have to track not only your direct to consumer, your wholesale marketplace, and then how that goes up against the threshold in that particular state. So, and again, it's different. So you can see here, it's all over the place in regards to what states track what type of revenue you're doing and through which channels. Now, here's another one, product taxability. Now, don't shoot the messenger because I didn't make this stuff up. But depending on what you're selling will depend on what's taxable in that state. So you look at clothing apparel. Some states it's taxable, some states it's exempt. Food and beverage is probably, I'd say, the most complex, because not only do you have products that are taxable and or exempt, but a lot of states have reduced rates. So, the sales tax rate is 8%, but in that state, they reduce the rate to 4% as an example. So all of that matters, and mapping your products to whatever platform or system that you're using to make sure the correct sales tax rate is applied will be important. Supplements, healthcare. Now, SaaS is an interesting one, right? Because you have some states that tax it, and like in Texas, they have a reduced rate in the state of Texas. So as you can see, all of those products that I've listed all have different variable rates depending on the state, versus a product that's just tangible personal property, which is taxed in every state. It doesn't matter what the state is, it's taxable. And we always laugh at, Uncrustable, right? That you would think, oh, that's a food item. Well, that's exempt in New York. So here are some other aspects that I think as you continue to grow your business, you just need to be aware of. And I get a lot of customers that, the fear of the unknown is the biggest, the scary part. And, I get a lot of customers that say, hey, my business is growing so fast, I haven't collected or remitted. And what do I do? And because there's some cost and exposure to the business by not addressing this early on and staying on top of it. But one big blind spot is just not collecting and remitting. Happens a lot, and there's ways to fix it. So, and I'll touch on that here in just a minute. But and when you're not tracking it and filing it, then you get into some past due liabilities, P&I, that does start accruing and can add up pretty quick. So I think the other thing too is a lot of customers that I've spoken to is they've set their account up in whatever system solution that they're using, and they've done it incorrectly. So I've talked to customers that have said, oh, well, or businesses that have said, well, I sell in every state, so I just went in and I clicked on every state to charge sales tax. And now you're collecting sales tax, and one of the big no-nos in sales tax is to collect it and not remit it. So you want to make sure that you're setting up your account correctly, so you're only collecting in the states that you actually need to. So you need to track where you need to collect, and then only charge sales tax and remit it in the states that you actually need to. So, and I think the international piece is another one. Businesses that are like, gosh, my business has grown, and they really haven't paid attention in great detail in regards to their global sales or international sales. So that can sneak up on you as well. And as I said, there is a path to get it fixed. So the good news is if you haven't addressed this, there's a way to do it. And I guess the first thing is just to understand, where do I stand? What is my exposure? You know, to do a sales tax assessment, do a nexus study. Where am I charging sales tax? Where should I be charging sales tax? And I think the other big piece is, what's my exposure in each of those states? So then you can make a business decision as to best how to tackle each state's situation based on the liability that you owe. And there's different strategies, right? You know, the cleanup work, right? Well, you need to register, but do you just register back to February of this year and then just do the past due filings and pay penalties and interest? Or if it's a large amount, do you do a voluntary disclosure agreement, which is a lot much more involved, but you have a little bit more flexibility in regards to negotiating with the state as to hopefully reducing that penalties and interest that you have with the state. So there's a number of different strategies too, depending on the amount, how long you should have been collecting, etc. I think the other piece too is just making sure you have a strategy. You know, technology is great, but technology only gets you so far, because again, the technology will do what you tell it. And I think that technology with the expertise, whoever you leverage or whoever you work with, just make sure that you have access to that tax expertise. Because one, it's going to save you time, but two, it's all about risk reduction. You're putting your blood, sweat, and tears into building a business. Don't get tripped up over sales tax. Customers today are used to paying it. So there's no risk that I've seen that if you start charging sales tax in a state that you're going to lose business. You know, 15 years ago when I was, you know, starting this out, that was a conversation I had quite a bit. They're like, wait a minute, what if I start charging? My competitor isn't. Most businesses today are charging sales tax, and they're charging in multiple states. So it's not uncommon now. It's just part of business. And so, and here's the other thing, just emotionally, you know, it's done right, and you can sleep at night. You don't have to worry about, you know, penalties and interest or exposure to the business. It's done right, and there's comfort in knowing that. So that's all I had. I tried to go through because I know we wanted a little bit of Q&A at the end. So happy to answer any questions that anybody has.
All right, cool. Great. Thank you, Cleet. Really appreciate that. Also, Rayla, do you mind putting it back to the slide that just has the QR code for the Finaloop team also, just to make, because I just want to make sure people know how to reach out to you guys.
Absolutely.
Or maybe Cleet can do that if you have the full.
Oh, yeah, Cleet, you want to just go back to that slide?
Hang on, which slide?
So Rayla, just back to the one that has the Finaloop.
It's on, you can put it on the cover. The cover page has it.
Perfect.
We'll go back up to the beginning.
So just looking through some of the stuff that came into the Q&A, originally August had asked, like, if you work with someone like Finaloop, do you do back taxes? You just start now? Like, how does it work?
So it really depends on the specific situation. First of all, in terms of the tax services that Finaloop provides, we create your financials in a very tax-friendly way, but then you still need a CPA to actually file your return. So what we do is we have a partnership with some amazing e-commerce focused CPAs who then take our financials and do your tax returns for you. So we're happy if you want to reach out, we're happy to connect you with somebody to speak to as well. And then that would depend on what kind of taxes and what your tax situation is and what your needs are. So, if you haven't done this for a few years and you need some catch up, then we can cover that as well.
Okay. Rayla, one that came in was like, does the IRS look at your meeting calendar? Which I think is just a general question of like, if they're looking into your stuff, then something like you've done something that they're a little suspicious of in general, right? And now they're auditing you. How deep would they go in an audit? Because you showed that like meeting calendar. Are they going to check that against every expense? How is that going to go?
Okay, so the real answer, and I think this is the answer probably in every situation as an accountant, is it depends. I can tell you that in all of my years of experience, I have never seen that. I've never seen that being raised in an audit, but it doesn't mean that they can't. So it's definitely something to think about. But it really, again, it's hard to know for sure, but I have not seen that in any of my experiences.
Okay. So I know there were a bunch that came in through the chat. I'm just looking at what is
Sure. I did see a bunch of questions on an LLC and what the best way to pay yourself is. So I think maybe that it sounds like maybe I wasn't too clear in terms of the different tax structures you can have with an LLC. So I just want to review that one really quickly, if that's okay.
Please.
So basically with an LLC, again, LLC is the legal structure, but it really depends on what your tax structure is. So if you are a single member owned LLC, then you're a sole proprietorship. In that case, you can't pay yourself a salary, and instead you would just take owner's draws as you're taking money out of the company. There's no difference from untaxed perspective from you and the business. The IRS sees you as one entity. If you're a partnership, or sorry, if you're a multi-member LLC, then you would automatically be treated as a partnership. So same there. There's no such thing really as a salary, but there is something called guaranteed payment. And again, that really can be somewhat complex. So I would speak to a CPA about it, but that option does exist. And then once we talk about if you're an LLC that made an election to be treated as an S corporation or as a C corporation, then you can be an employee and pay yourself an actual salary using a payroll service and withholding and doing all of that fun stuff.
All right, and yeah, keep the questions coming if you guys feel like there's stuff that was okay. When will the bill pass that helps you deduct 100% of R&D costs?
So it's still an if, not really a when. I wish tax was that certain all the time, but at this point, it's still an if. So it was just recently passed in the House. Again, it was passed by one vote, and now it's going up to the Senate for a vote. I don't remember offhand the exact date that the vote is expected to happen, but my guess is that the Senate will probably want to make their mark on the bill as well before it's being passed. And also one other question that I see here, which I think is an interesting one, is someone had asked about, if they can get the standard mileage deduction, if they also have expenses related to gas and everything like that. So with both the home deduction and the vehicle deductions, just to clarify this point, as I mentioned, there's two ways that you can really benefit from this deduction. One is really simple, where you have a standard rate that you can apply. So for a home deduction, if your office is 10% of your total square foot of your house, you can take up to $5 per square foot, up to $1,500, and use that as a deduction. Or you can really make a list of all of your home related expenses and take the percentage related to the home and see how that comes out. That one could be really beneficial. It's just is a bit more of an admin burden to track all of that information. And the same with your vehicle. You could either take that standard mileage of 67 cents per mile, or you can actually do the calculation of tracking all of your vehicle related costs, and then taking the percentage of the time that you use your car for business.
Okay. Another one came in that was about estimating your tax payments as an LLC. I know I've been hit by that before, not doing the estimated tax payments and then getting a little bit of a fee for that.
Yeah.
So someone asked, how do you do that as an LLC? What if you under or overpay?
So again, it depends on an LLC. It really always depends on your tax structure. Tax structures and legal structures are not the same. I will say for this one, you know, the reason that this is that I didn't bring up is I would really expect and hope that the CPA that you're working with would, you know, things like that are something that should be covered with your CPA, so they can really make sure that you're making those estimated tax payments on time. But of course, you also need to track that throughout because it's one of these things that as long as you're tracking it correctly and paying it on time, there's no need to get these penalties. It's a waste of the penalties on that side.
All right. So we are just hitting the end here. So I know there are a lot of specific questions that came in that we probably didn't get to. Some are particular people's situations. I want to encourage you guys to reach out to the Finaloop team. I just put the link for a consultation with them into the chat here. If you want a free consultation, you probably saw earlier in the chat, there were a lot of people who were big fans of theirs. I saw Nate mentioned he has 9 clients using Finaloop now, 10 out of 10 would recommend. So if you guys think you might need to chat with them now or in the future, feel free to set up that free consultation. So again, the link is, I think, on the screen share, but it's definitely in the chat that I just put in here. And then you can also probably chat with Rayla on LinkedIn, maybe for one of these questions. But yeah, I'm sorry if we didn't get to your individual question for now, but thank you. Thank you to Cleet. Thank you to Rayla and the Finaloop team. And if you want to watch any of the earlier Finance 101 series, if you didn't catch those are available on our YouTube. All right, Rayla, anything as we wrap up here?
No, thank you so much. Appreciate you inviting us on. And again, when it comes to tax, everything is super company specific and really devils in the details. So please reach out. I'm happy to help with anything that I can. But obviously, you know, some things really come down to those details and making sure that you're speaking to your CPA and raising those right questions for your specific structure.
All right. Taxes are scary. We appreciate someone guiding us through the darkness into the light. Thank you. Thank you both.
Thank you
Really
so
appreciate
much.
it. Bye, everybody.
Bye.